In 2022, Ark ETF, including the flagship Ark, has maintained a downward trend with severe losses. The decline has been so steep that these ETFs are at or near the same levels where these were just before the COVID-19 induced meltdown. Recently, a news house even compared the Berkshire stock with Ark, which made a steady gain over the same period and almost reached the same level as Ark in classic clash of value versus innovation driven growth. Yesterday, we saw a big sell of Palantir position by Cathie in a flip-flop given several recent buys at a relatively higher cost. Like me, many will have the following question. Is innovation and growth dead and time to move to value investing? What's wrong with RK? And why the decline has been so severe despite the overall portfolio of companies and broad macro thesis has worked out similar to what they have predicted? Why sell Palantir only after buying it so recently and at a higher cost? In this video, we are going to use strategic thinking to answer some of these questions. Hi, welcome to IndustriaNX and I'm your host Sachin Sharma. In the trading session of 31st January 2022, Ark sold more than 3 million plus Palantir shares from most of the ETFs that hold Palantir except the flagship Ark ETF, which is almost 50% more than what they have bought in recent times. Palantir stock has been in a downtrend for the last few months and retraced back to as low as $11.76. The recent buys were in a range roughly 25 to 30% higher than the current price. So they have booked losses on Palantir. So the question here is why Ark has changed his position over Palantir and what has triggered the selling of Palantir in this big chunk. Cathie has maintained views on Palantir as a long-term player, and in her thesis I find her more bullish than mine, with views on even stealing AWS and the cloud market in the future. Last year in Q1, during a CNBC segment, Cathie Wood, after adding to her bet on Palantir, said that CEO comments are music to her ears. She said she upped the bullish position in Palantir after hearing management comments about aggressively investing in the future. Her exact words were, "It's exactly how we invest. We want our companies to invest aggressively. We do not want profit now." This statement was in line with our philosophy on investment for the long term based on their research and thesis in disruption and innovation. There has been significant evidence that they were able to capture a few trends and make a killing on topics, especially on EV and Tesla success, better than the whole street. Except few trimming sales, Ark has been a buyer of Palantir mostly over last year, and until most of January 22. Palantir has returned roughly 44% year-on-year revenue growth in terms of performance, initiated new go-to-market channels, acquired several new customers, and expanded its sales and product development team rapidly. The macro for Palantir business both in government and commercial sector is improving. Cathie also published an article in December titled "Innovation Stocks Are Not in a Bubble. We Believe They Are in Deep Value Territory." In this article, she shared a few key insights. She opened the article by stating that throughout her career, when disruptive innovation strategies have fallen out of favor, her primary concern has revolved around her clients. Perhaps influenced by negative headlines in the media and by the inherent volatility of our strategy, some clients have sold near the bottoms of market cycles, turning what otherwise would have been a temporary losses into permanent losses. She said that for that reason, Ark places significant focus on its 5-year investment time horizon. Its primary message is that innovation solves problems and is expected to transform human lives at an accelerated rate during the next 5 to 10 years. She said that historically and according to Ark's research, this concentration of our portfolio during correction has led to significant absolute performance and relative outperformance as the market rebounds. I want you to remember the word concentration from here. She also said that after correcting for nearly 11 months, innovation stocks seem to have entered deep value territory. Their valuations a fraction of peak levels. Many skeptics attributed our outsized positions last year to stay-at-home stocks and expected their fundamentals to deteriorate this year. So why sell now, and that too after purchasing over last few months? To understand this, we need to see some simple performance chart comparison. If we see the performance of flagship Ark ETF over the last 12 months, it started near $142 and after making highs of nearly $160, it is now at almost $75. Not far from its 12-month low, and a decline of almost 54% from its 12 months high. Fate of other ARK ETFs shows similar trend and story as well. If we see Tesla, a company that embodies ARK philosophy over the same period, it started near $840 after a very hot run of more than 100% gain since October 2020. And after making lows of nearly $540, it made highs of $1,243 and is still trading at or above the starting price of February 2021. And at the time of this video, it is near $936, that is more than 11% gain in a year. These are two contrasting stories. It reveals few chinks in the ARK strategy that may or may not matter over the long term, but still accentuated the effects in the last 12 months. ARK ETF underperformed both major indexes and even the flagship companies in their portfolio. For a long, they maintained the 10% cap rule for the company's maximum position, which was applied to Tesla many times. Yet we saw periods during the year where Tesla was lower in its weight in ETF than the 10% ceiling. So in short, overall, they had less Tesla in the portfolio related to the previous years. The funny thing is that since S&P inclusion, more and more institutions are buying more Tesla, and its results are through the roofs. Yet the one fund that symbolized Tesla more than anyone went underweight in the context of its thesis, which was updated to even further high price target in this year. It was a tactical mistake, and it has costed performance to ARK ETFs. The fundamental dynamics that have forced ARK to commit these tactical mistakes are following. First is their strategy of maintaining the 10% cap and poor risk management in deploying the capital. ARK needs to maintain a 10% cap on a maximum position for a company, which triggers forced selling at times. Yet they also need to ensure that when the money is taken off from this company is invested back in different stocks of companies that carry similar S-curve maturation and risk reward performance to maintain the portfolio's overall volatility. However, as we see that ARK ETFs have declined in performance despite keeping positions in Tesla in their portfolio because the money that was taken from Tesla sales was invested in companies that have given even poor performance. So if we try to imagine ARK's performance after excluding Tesla, then the picture is even dimmer. During this decline, ARK should have opted for some companies in their portfolio slightly overweight, which have better performance in terms of risk reward or maybe a similar technology maturity and S-curve position as Tesla. When the money was taken out of Tesla and some other companies, it was invested in the companies which were far behind at times in risk reward performance and yet to prove the innovation of the scaling potential similar to Tesla. The risk profile on the portfolio increased, which when combined with the decline of the growth stocks over the last 12 months has made the situation worse for them. In short, they sent good money after bad. The second tactical mistake that ARK committed was not modifying the fund structure to accommodate private companies. Companies are staying private for longer. Despite overall stock market sentiment on growth, the private market has seen companies' valuations soaring in the private market, especially in the innovation and tech sector over the last year. For example, if you see companies like Klarna, they have gone from a valuation of 5.5 billion in June 2020 to almost 46 billion in March 2021. Similarly, the companies like Stripe, Data Robots, SpaceX, and many more soared in the value in the same market. And thesis section where ARK maintained bullish thesis and yet they failed to figure out ways to accommodate these companies in the fund structure. Lack of ARK's access to private market failed them to sit on the side while these companies soared in value. A fund or ETF that has been mandated to find and invest in disruptive companies with no exposure to private market is handicapped in its mission for its investor in some ways. We can discuss on it for long what are the different ways to achieve it. Still, it's not impossible given the level of financial engineering that exists today. Another reason for ARK's tactical mistake was rushing into the IPOs like Robinhood, without accounting for the overinflated valuation in private markets created by institutions, Wall Street, banks to favor their creed. It is well established how valuation can be swayed when popular companies go public to make a quick buck by dumping positions acquired just before IPO. If you see the private market, you will see how the valuations are pushed in by venture capital, investment banks, and institutional investors in an aggressive manner to secure a position in these companies before they go to public market. They have an advantage as the access is restricted to accredited investors only. Many of these companies are good and will be quite significant in the future. But using that to inflate value with a short term view of mentality is similar to killing the golden goose to take all gold at once and has a heavy price for retail investors. These companies' valuations are running ahead of themselves, which means that when they come to market, most companies have a similar impact on retail investor jumping to buy IPO as a tsunami on a coastal areas. Investment banks and institutional investors write very juicy and exciting reports before IPO. But since these companies still have a lot to prove in terms of the performance, the valuation at which they are currently being measured naturally decline over the next 6 to 18 months, especially during or at the time of lockup expiry. So, entry into a company at the time of IPO exposes you to this risk in today's market. In short, it's a risky strategy, and Ark has paid dearly because of it, especially in their position in Robinhood. So, they have a long term strategy that is increasingly focused on short term sell and buy with sometimes bad entry and exit strategy. Putting these three things together, we can see Ark has made some tactical errors, which has led to its overall underperformance over the last 12 months. Another debate is the choice of certain companies in the portfolio, but that could be part of focus issues in the fund instead of tactical error. And let's keep that for some other discussion. There's something else that likely has hastened some of these actions. Between 2015 and the onset of COVID, many people in finance media and the Wall Street community have looked down on Cathie and Ark. In their opinion, she was playing with fire and will go down in flames, primarily due to the bullish betting Tesla. So when Ark's performance decimated many traditional investors, especially those shorting Tesla, it hurt many people's ego on the street. Many anchors who were raising questions on Tesla were forced to change their positions and their grudges were spilled back on Tesla and Ark on the issues of trivial values. Now, in the last 12 months, when Ark underwent a trial by fire due to some of the problems we discussed earlier, the knives were out on them. Some of this likely went under their skin. Recent criticism and underperformance have led to hasty actions and flip-flops on position. We all have seen people like Jim Cramer on CNBC segment of Mad Money go on a parody routine to make a joke of Ark. This is just an example of bruised ego who uses the opportunity provided by Ark to smear salt on their wounds. A new low for himself, but that's Jim Cramer. He always finds new ways to go even lower than expected. There is also some reset in thinking and reevaluation of position sizing, most likely given the bottom in many stocks and view on the performance of near to midterm. The recent flip-flop in position is indicative of the behavior of evaluating near to midterm performance and an effort to time the market to improve return. It could also be the tactical that use the current decline to change weight and concentration in the portfolio. So why Ark is selling Palantir even after buying that sort of reasonable prices in the recent past? My view is that they consider that the same capital can be deployed in other companies for now, that on a relative basis near to midterm can provide better return and later on money can be rotated back to companies like Palantir. Another way to phrase the same argument is Ark see inflection points of growth and appreciation in some companies better than Palantir as of today. Ark recently released their annual research report, Big Ideas 2022. They are placing great value on potential wide new disruptive technologies, example AI, IoT, cloud computing, robotics, blockchain, autonomous mobility, and many more. Palantir has offered solution in all these domains. They see Palantir as a strong candidate to capture this value by their own admission. So current selling is resulted by three things in my opinion. Underperformance pressure, view on capital deployment in near to midterm on companies where Palantir in their opinion lacks. So in a way they're kind of mixing a long-term strategy with a near-term market timings. The third is fund risk profile reset due to opportunity provided by the market with a decline in growth stocks. Since the flagship Ark ETF is excluded for now, it's interesting to see how it fares in the next few days. If RK see no major selling of Palantir, then it will be likely that out of about 3 points, rebalancing based on recent opportunities and capital deployment might have led to these decisions in view of better opportunity. However, it is not easy to neglect that some of the entry-exit decisions across all the ARK ETFs over the last 12 months and to rule out that they are not under pressure to perform. It doesn't matter who you are. If you manage public money and you are down 50%, you are under immense pressure if you are true to your fiduciary duties. The last question is growth and innovation dead and time to rotate for value investing? The answer to this depends on your view of the future and your own risk appetite. I see that AI, IoT, robotics, and many disruptive technologies are still in their infancy. Many times a day, I think about how a different process and problem can be solved using some of these technologies. We are at a great convergence of many technologies, so likely we see more robust trends than actually modeled by many analysts. One word of caution though, the performance in these technologies is going to be heterogeneous and violent. That is, only a few will emerge as winner and many will perish. Also, accredited investors have the advantage to cook valuation in private markets and sell you a cake too hot to eat at the time of IPO. So be aware of it. As we discussed in the context of ARK, that even after getting the macro thesis right on many of these disruptive technologies, they yet underperform by mixing short-term and long-term strategies, time the market, and lack to the private market access where most returns in disruptive technologies are made. We have to give Cathie on her effort of bringing innovation and disruptive investment mainstream and taking a path that is different from a club culture fester at Wall Street and analyst community. Her long-term thesis on various technologies are well researched. Still, the flaws in fund structure compounded with frequent reallocation of positions in a small interval is hurting the long-term investment strategy in my opinion. In full disclosure, I am personally long in Palantir at a personal level. I'm sharing it as a part of the disclosure, not as a financial advice. Please be advised that the purpose of this video is to educate and teach tools on how to deploy strategic thinking on business and investment problems in an outside-in manner. All contents are presented for education, information, and entertainment purpose only, and no portion of this content should be used as financial advice. Please do share your feedback in comment section, and if you enjoy the content, do like the video and subscribe to the channel. See you next time. Goodbye.